Hey there and welcome. Does looking at mutual funds ever feel like you're staring at a giant menu with way too many options? It can be pretty overwhelming, right? Well, today, we're going to simplify that menu. We're breaking down 10 key types of mutual funds so you can figure out how to build the perfect financial plate for your own goals. You know, the best way to get your head around mutual funds is with a really simple analogy. Just think of them like a thali, that big platter with a bunch of different dishes on it. You get to pick the combination that's just right for you. Maybe some parts are stable and reliable, and others are a little more spicy and exciting.
But that's the big question, isn't it? With more than 10 options on the menu, how do you actually build the perfect plate for your financial appetite? That is exactly what we are going to unpack. We'll start with the safest dishes and then work our way up to the ones designed for some serious growth.
Okay, let's start with the foundation of our thali. These are the funds all about steady, predictable returns. Think of them as the rice or roti of your meal, the essentials that give everything else stability. We'll look at a few options here, and they're all built around one idea: safety first.
First up are debt funds. The idea here is actually pretty simple. You're basically lending your money to the government or big companies, and in return for that loan, they pay you interest. This makes them a fantastic choice for anyone who's really focused on safety and wants returns that are a bit more predictable.
Now, a slight variation on that is the monthly income plan, or MIP. This is still mostly invested in those same safe debt instruments, but it adds a small slice of stocks, or equity, for a little bit of growth potential. You can almost think of it like a pension plan that's linked to the market, perfect for folks looking for a regular stream of income.
Next, you've got fixed maturity plans, or FMPs. These feel a lot like a fixed deposit you'd get at a bank, but the key difference is they're linked to the market. Your money gets locked into debt instruments for a specific amount of time. So this is ideal if you have a clear timeline in mind and you want a return tied to that exact period.
And for the most cautious investors out there, we have capital protection funds. Honestly, the name says it all. The number one goal here is to protect your original investment. Almost all the money goes into super safe debt with just a tiny bit in stocks to maybe generate a little growth. It's the ultimate safety net.
So, you've got your foundation set. It's safe, it's stable. But what if you're thinking, hey, I want that safety, but I'm getting some serious FOMO about missing out on growth? What's the next step?
Well, that takes us right into the balanced middle of our thali. These are the funds that give you a mix of both worlds, kind of like the sabzi and raita that perfectly complete the main course by offering both flavor and substance.
Leading the charge here are hybrid or balanced funds, and just like having rice and curry on the same plate, these funds give you a preset mix of stocks and debt. It's a fantastic, hands-off way to get a balanced approach to risk and return without you having to manage the two sides yourself.
Okay, but what if you want to just ride the market's wave without trying to be a stock-picking genius? That's where index funds come in. They do something very simple. They just copy a market index, like the Nifty 50 or the Sensex, which are really just baskets of the country's biggest companies. The strategy is to just follow the index. It's become a super popular choice for low-cost, hands-off investing. All right, we've covered the safe and the balanced. Now it's time for the growth engine. Let's get to the spicy, special items on the thali. These are the funds that are really designed to aim for higher returns and long-term wealth creation. And the main dish here is, of course, equity funds. This is where your money gets invested directly into shares of companies. What's so cool about this is that you can own tiny pieces of giants like Apple or Reliance, all without needing a special stock trading account, which is called a DMAT. For a lot of people, this is the number one way to build wealth over the long term.
But hey, why limit yourself to just one country's menu? International funds let you invest in stocks overseas, which gives you a fantastic way to diversify your portfolio across the entire globe. This means you can invest in some of the most innovative companies in the world right from your couch.
And yeah, we are talking about some of the biggest names on the planet. Through these funds, you get a piece of global innovation from absolute titans like Apple, Tesla, and Google. It's true diversification on a worldwide scale. But growth isn't just about stocks. You can also invest in real estate funds, or REITs. This is a really interesting way to own a piece of a whole portfolio of properties. Think office buildings, shopping malls, you name it. You basically get to be a landlord and earn that rental-like income, all without the headache of actually buying a flat yourself. And finally, we have a true classic: gold funds or gold ETFs. This lets you invest in digital gold without any of the worries about physical storage or security. Historically, a lot of people see gold as a great way to protect their portfolio against inflation, helping it hold its value when prices are on the rise.
Pooh! Okay, we have seen the entire buffet of options now, from the simple and steady to the spicy and high growth. So after all that, how do you actually go about building the thali that's perfect for you?
Well, when you boil it all down, it really comes back to a simple trade-off, which our thali analogy captures perfectly. Are you looking for those spicy equity options that come with higher risk but also higher potential returns? Or are you leaning towards the simple debt options that offer lower risk and more predictable stability?
And that means there's no single best fund out there. The right choice is deeply, deeply personal. It depends completely on your own taste, which, in the world of finance, just means your personal comfort with risk and what your long-term financial goals are.
So that leaves us with one last question for you to think about. After looking at this whole menu, which type of mutual fund do you already have on your plate? Or which one are you now curious to try? Your answer to that is the very first step to building your own perfect financial thali.